I think you just put the question very accurately in a tangible way, and the answer is no. Because as you know, it's a split Congress, and the Senate is still controlled by the Republicans. And when you think back to 2010, when the Republicans controlled the House and the Senate was controlled by the Democrats, the Republicans wanted to reform Dodd-Frank, and nothing happened because everything died in the Senate. And I think that's going to be the case today. Yes, she's going to make some headlines, but in terms of actually in a tangible way affecting the banks, we don't see that happening over the next 2 years.
All right, let's talk intangibles, though, as well, because a lot of bank investors were hopeful that there would be a continuation of the deregulatory push that the administration has already embarked upon. So could the House Financial Services Committee, under Maxine Waters' chairmanship, halt that, grind it to a screeching halt, and or, since they oversee the Fed, make it more difficult or require the Fed in some way to have more oversight of the big banks?
The answer is no. She's not going to be able to grind it to a halt. As you know, the regulatory agencies all have new heads. These heads were appointed by this administration, and all of these agencies are moving toward deregulation with proposals offered as recently as last week in changing the asset size of different regulatory banks. As you know, the CCAR was changed with the legislation that was passed earlier this year. So I think, yes, they will present more often to this House Finance Committee, no doubt about it. They will probably address issues of their concerns, such as consumer lending. But overall, in terms of actually rolling back or halting deregulation, we don't see that happening. And we didn't see it happening, again, back in 2010. So as long as there's a split Congress, we don't see any major changes coming.
So what do you see in terms of, potential headwind? I mean, obviously investors are sort of looking ahead and thinking maybe there's something, a headwind for this group. And, a lot of banks on the eve of the midterms had said, if there is a split Congress, they are concerned about their forecast for the 10-year yield and implied that the yield curve would in fact be flatter. I know you're not a rates guy, but how do you interpret the results of the midterms and the impact on the yield curve, since that is such a crucial part of the bank trade?
No, you're absolutely right. The 10-year government bond yield is very important to the profitability of the industry. The industry prefers a steeper curve, and that's going to be more, we think, influenced by the economic activity of this country. If inflation starts to pick up in 2019, the yield curve should steepen. As you know, the Fed is now shrinking its balance sheet, and that also could put upward pressure on the 10-year government bond yield. So again, I don't think the House is going to have any real influence on the 10-year government bond yield. It's going to be, again, more a economic-driven event, as well as the Federal Reserve shrinking its balance sheet. And that, I think, is favorable for the banks over the next 12 to 18 months.